slide your plastic card into the machine. You punch in your 4-digit PIN and wait for the screen to light up. There it is. A 5-digit number. $50,000. You feel a quiet wave of relief wash over you. You look at that number and you see safety. You see your late nights, missed weekends, your accumulated sacrifices. You believe that money belongs to you. You believe it is sitting inside a secure electronic vault for your command. But you are completely wrong. The exact millisecond you handed that cash to the teller, or the exact moment your digital direct deposit cleared, that money stopped being your property. Legally, it became the property of the bank. You did not deposit your money for safekeeping. You granted a low-interest, unsecured loan to a highly leveraged corporation. In exchange for your life savings, they gave you a digital receipt and a legal promise to pay you back when you ask for it. But what happens when the institution can no longer keep that promise? What happens when the underlying foundation fractures? If you are ready to see the hidden machinery of the financial curtain before the doors lock, subscribe to the channel, turn on the notification bell, like this video, and share it. Leave a comment below with the exact moment you realized your financial safety was an illusion. Most people believe that if a major banking institution faces collapse, the government will step in with a massive bailout, using taxpayer money to rescue the system. That was the old rule. That was the playbook of 2008. The financial elite realized that printing trillions of dollars to save reckless executives caused too much public outrage. So, quietly changed the law while the middle class was sleeping. They created a new mechanism called a bail-in. Under a bail-in structure, a failing bank is forbidden from looking to the government for survival. Instead, the bank must look inward. It must look to its creditors to absorb the losses. And because your hard-earned deposit is legally classified as an unsecured loan, you are the creditor at the very bottom of the priority ladder. They do not need to steal your wealth in the dead of night. They have granted themselves the absolute legal authority to freeze your account, confiscate your cash, and replace your savings with worthless digital shares of a bankrupt bank. You think your money is sitting quietly in a steel vault. It is not. The moment your deposit clears, it is mobilized. The bank takes your $50,000 and leverages it. They lend it out over and over again, multiplying the numbers on a screen. They package it into complex derivatives. They make high-risk bets in global markets using your financial safety net as their poker chips. When they win these bets, the executives keep the profits. They pay themselves massive bonuses, buy private jets, and declare record-breaking quarters. What do they give you in return? A fraction of a single % in interest. A microscopic dividend for carrying the ultimate risk. Accept this uneven exchange because you firmly believe the system guarantees your safety. You believe the government will always be there to catch you if the bank falls. But risk in the financial world never disappears. It is merely transferred. In the catastrophic crash of 2008, when their reckless bets went entirely bad, the public was forced to cover the losses through massive taxpayer bailouts. The global outrage was deafening. People marched in the streets demanding accountability from the bankers. So, the financial elite retreated behind closed doors and drafted new global legislation. They introduced the bail-in framework and sold it to the public as a massive victory against Wall Street greed. They proudly announced to the cameras, no more taxpayer bailouts. But they lied. They did not eliminate the bailout. They simply changed who pays for it. Shifted the catastrophic burden from the collective taxpayer directly to the individual depositor, to you. If the derivatives market fractures tomorrow and your institution faces sudden insolvency, the executives will not beg the government for a lifeline. They will simply look at the internal ledgers. They will look at your account. By absolute legal right, they can freeze your balance on a Friday night. They can sweep your $50,000 to recapitalize their toxic balance sheet. In return, they do not owe you your cash back. They do not owe you an apology. They will forcibly issue you shares of stock in their failing institution. Sleep on Friday, believing you had $50,000 of liquid cash, and you woke up on Monday holding the worthless equity of a collapsed financial casino. You might be thinking about the insurance. Government guarantee. The little sticker on the glass door of the branch that says your funds are protected. You sleep well because you believe that sticker is an impenetrable shield. But let us look at the mathematics behind the glass. The insurance fund does not have the capital to cover a systemic failure. For every $100 sitting in commercial accounts, the insurance fund holds barely over a single dollar in actual reserve. It is not a financial safety net. It is a psychological pacifier. It works perfectly if one small, isolated bank makes a mistake. But if a major interconnected institution begins to bleed, the insurance vault empties in a matter of hours. And when the dust settles, a brutal legal hierarchy takes over. Bankruptcy is a physical line. You need to know exactly where you stand in it. When a bank fails, the law strictly dictates who gets paid first. Very front of the line are the derivative counterparties, the massive trillion-dollar hedge funds and global institutions that your bank was gambling with behind closed doors. The law classifies them as secured creditors. They are legally entitled to strip the remaining liquid assets immediately. Very back of the line, standing far behind the corporate bonds, behind the administrative legal fees, and behind the secured debts is you, unsecured depositor. You never read the terms and conditions when you opened the account. Nobody does. It was 40 pages of dense legal terminology designed to exhaust you into signing on the bottom line. If you had hired a forensic financial lawyer to translate it, they would have told you the terrifying truth. You signed a subordination agreement. You legally consented to be the financial sandbag. You are placed at the bottom of the door to absorb the floodwaters so the institutions on the top floor can keep their ledgers dry. Your money is the buffer that protects the billionaire class from their own reckless mistakes. It is a quiet Thursday afternoon. You are sitting at your desk, scanning a news feed. You see a headline about a major regional bank experiencing liquidity pressures. You do not worry. That is not your bank. Your bank is a global titan with marble columns and billions in assets. But the financial system is not a collection of independent islands. It is a highly compressed, interconnected web of counterparty risks. By Friday morning, the panic spreads. It doesn't move at the speed of human feet anymore. It moves at the speed of light through fiber optic cables. Millions of people log into their mobile apps simultaneously, frantically trying to move their liquid funds to safety. The system detects the surge. The algorithm recognizes that the bank does not possess the physical cash or the liquid reserves to satisfy the demand. The trap springs shut. You tap the transfer button on your screen. The wheel spins. It spins for 10 seconds, 20 seconds, then a red error box appears. System temporarily unavailable. You refresh the page. Your balance is still there, $50,000, but it is completely frozen. You cannot withdraw it. You cannot wire it. You cannot use your debit card to buy groceries or pay your electric bill. Digital illusion has vanished, leaving behind the hard, unyielding reality of the legal contract you signed. While you are staring at a frozen mobile app, a completely different reality is unfolding on the top floor of the high-rise. Ultra-wealthy do not leave their capital vulnerable to the bail-in mechanism. They do not maintain massive, stagnant cash balances in commercial deposit accounts. Months before the first headline leaked, their family offices and private bankers had already structured their wealth. They hold their liquidity in short-term government treasuries, insulated from corporate banking default. They utilize automated custodial sweeping networks that split their cash across 50 different institutions, keeping every dollar beneath the legal insurance threshold. Leverage private offshore trusts outside the jurisdiction of domestic bail-in laws. The system does not lock them out because they do not play by the rules written for the middle class. Gates only close on those who believe the bank was a vault rather than a casino. You step away from the frozen screen. The reality of the financial architecture finally settles in. The bank is not a vault. It is a highly sophisticated machine designed to extract capital from the bottom to insulate the top. When the economic weather is clear, take your money and gamble it for their own profit. paying you fractions of a penny for the privilege of risking your life savings. When the system breaks, they do not ask for a government bailout. They use your money to absorb the impact, legally converting your lifetime of labor into worthless equity so their institution can survive another day. The bail-in is not a glitch in the legal code. It is the ultimate safety valve for the financial elite, carefully legislated while the public was distracted by the illusion of a government guarantee. You finally realize the bitter truth about the banking system. Wealth in the modern era is not defined by how much money you have sitting in a commercial deposit account. Wealth is defined by your proximity to the legal exit doors before the fire starts. The elite spent the last decade building their fire escapes. They structured their private trusts, diversified their assets across offshore jurisdictions, and they moved their capital far out of the blast zone. They left the middle class standing in the center of the room, holding plastic cards, staring at digital screens, and believing in insurance funds that are mathematically guaranteed to collapse under systemic pressure. The system is not broken. It is functioning exactly the way it was designed to function. It was built to protect the institution at the absolute expense of the individual. Time you walk up to an ATM, or the next time you open your mobile banking app to look at your balance, pay close attention to the feeling in your chest. Look at the glowing numbers on the screen. $50,000, $10,000, $100. It does not matter what the number is. The system does not see it as your money. The system sees it as their collateral. Stare at the screen, and the screen stares back. The money is not yours. It never was. It is just your turn to hold the digital receipt, waiting for the day the system decides it needs its capital back.